What is up? And welcome back to How to Invest in Commercial Real Estate. We're back. Every week. Anyway, we have a super exciting show today because we have our Fort Worth office guys with us today, Andy and Jackson. Andy and Jackson, what's up?
How's it going?
Andy's obviously thrilled to be on. Anyway, we opened our Fort Worth office in Criterion. Obviously, Andy helped out a ton with that and was instrumental with that in 2022. Is
that right?
2023. Okay, so last year. Yeah, and then the beginning of this year, we were able to expand that office quite literally and bring on additional team members. So we now have Jackson over there working with Andy, and we've been super excited about this because it's kind of exposed us to a completely different market. You know, DFW is this massive market. I think there's like 5 million people in DFW. More?
I think it's more.
We know it's got to be more.
No, it's more than that.
It's got to be more. Anyway, we're super excited to have you guys on the show today. Unless you're an investor or you've worked with these guys before, you may not know them. You may not have heard from them a ton. So we're excited to have these guys on and kind of give some of their background and just talk through how we are looking at deals. All of us are looking at a ton of deals right now, especially Brian. Brian's looking the most. He's really just pounding it so hard.
Yeah. I've got a bunch on the line.
But
So we've all got our different perspectives of what we like and what we don't like. And yeah, excited to kind of dig into that. But updates. Yeah, what is going on right now?
So what about updates from last week? We sent out how many proposals or offers did we send out based on what we were talked about on the show?
17.
17, not bad. And are we close to getting close to contracts on any of those?
Yes. Yeah, we have agreed. We have the first agreed upon LOI. We have numerous counters. We have several people who told us pound sand and several more who said it's already under contract.
Yep. That's how it goes.
But that's why it's a numbers game. And, you know, we spent the time, we went through hundreds of deals. We found 15 or so that we thought we liked. We send the offers, and we only need one or two out of that exercise.
Yeah.
And hopefully we can do that exercise every month. And, you know, it'd be great to have a deal a month eventually, under contract and on the way to closing.
Yep.
Feds dropped interest rates 0.5 point. That was a little bit of a surprise. I mean, I think it was always between 1.25 and 1/2, but I heard a lot of pundits saying that, you know, they thought it was just going to be 1/4. So we got the full 0.5 point, and I think that's good. I think it'll increase liquidity and just general optimism in the market.
Yep. It's going to be amazing. I kind of think the Treasury's had it priced in a little bit. If you look at the 5-year Treasury, you know, beginning of September, we're like 3.4. Today, after the rate cut, we're at 3.5. Yeah. So, you know, kind of some demand maybe getting back in.
Bit. Yeah, it was priced in, and then, maybe some demand made it tick up a little bit.
Yeah, but all in all, you know, I think we're still looking at floating rates going into some of these deals. I think we're still going to see some downward pressure on those rates. Which is good for us and kind of is why we're making so many offers, right? And I think just relate it back to last week's episode, you know, we're getting on Crexie, we're just live finding deals. By the way, out of those 2 deals we offered, did we offer on both?
Mm-hmm. We did, yeah.
One of them was already under contract. The other one may have gotten back to us, and I think is in the shuffle of the 17. But yeah, beginning of last week, Brian had all these deals, right? That he found.
Yeah.
Anyway, we looked at all these deals early last week. Into last week, we were continually looking at them more and slowly started sending out offers Friday, Monday, Tuesday. We got the 17 out, and now we're just kind of rolling with the punches. So exciting stuff. I guarantee it will get maybe a few more than we need, but definitely I think 2-3 of these centers, you know, maybe 10, 15 million bucks before the end of the year, I think is very achievable. Goal for us.
Yeah, that'd be great. Well, so today we're going to introduce to our audience, or at least let them get to know them a little bit better, Andy and Jackson out of our Dallas-Fort Worth office. So real quick, maybe if you guys want to just kind of introduce yourselves and just give like a 30-second on your background, and then we're going to start asking you guys some questions about the market and how you go about finding deals down there.
Andy, you want to go first?
Sure. Happy to. So my background is I came from more of a development value add company. I ran capital markets for that company for about 6 years. Done business in about 15 states, but have always kind of looked more at the ground up construction. How can you create value out of an existing asset, whether by repositioning, re-tenanting it? So, kind of my background and what I look at is not only from kind of raising money from institutional groups, but it's also how can you take some type of asset and really turn it around or create the most value out
I like it.
Okay.
Jackson, what about you?
Yeah. So I was actually with Andy at that former company, working under him in the capital markets department, then took over it. So sort of the same background, development, acquisitions, but now I'm here at Criterion, VP of capital markets. So I would say now my day-to-day is more focused on, investor relations, chasing down deals, submitting LOIs, underwriting those deals, and yeah, just seeing where we can find value, whether it be adding investors, new lenders, great deals, anything like that. So yeah, it's been an exciting 6 months, guys.
So, Andy, talk to us about how you go about finding these deals. You mentioned you have a kind of a preference for value add. We've talked on the show extensively how kind of we go about it, but I'd like the audience to hear like what is your method? Who are you talking to? Where are the deals coming from, and how do you evaluate which ones to chase?
Yeah, most of the deals I look at are either sent to me directly from a broker that kind of knows what I'm looking for. So through existing relationships or email blasts. I've got some brokers that know me well enough that they send me off market deals that they have saying this fits the criteria for what you're looking for. My strength's always been, and that's why I've got Jackson, is I can usually tell you if a deal works or it doesn't work within 5 minutes. I can't necessarily tell you why or the numbers behind it, but I'm right maybe about 80% of the time. So my strength is I can look at a shopping center and be like, okay, that rent's way underneath for that box. I can sell these two things off. I can return money this way. I know who our partners can be both on the debt and equity. I'll use kind of the Little York Shopping Center as an example. That's a deal I looked at, and right away I knew I could sell those two out parcels, and I knew that we could bring in JV equity partners in for a large portion of that equity, and they came in for a big slug of it, and I knew who the lender was going to be, and they gave us a letter to close on it before we went under contract. So it's kind of how I look at things is how can you either break it apart, how can you increase rents, what tenants do you not want there and who's not in the market, and where do I think the capital can come from. You asked me to run a 10-year forecast on cash flow and back into CAM reconciliations. Probably not my best use of time or what I'm the best at, but I can usually find something that makes sense, and Jackson helps me figure out why.
So I'll put you on the spot a little bit, but what are some kind of red flags for you that kind of take you off of a deal real quick? Is it market? Is it, type of asset? Is it rent? Is it tenants that are there? What are some red flags?
I say it's a lot of demographic. If you don't have population growth, then what's the demand going to be there for new tenants? You're not going to be able to see the rent increases if you don't have good population growth, or you're in a very stable market. Call it some of the Midwest markets, Chicago, things like that, where you have a dense population. You may not have a huge growth, but you've got a lot of people there. And I think that makes up for something. But if you go to some of these secondary or tertiary markets where you don't have a lot of growth, and if you don't have a great trade area, it's great. I'd say tenants scare me. You don't want to go into a center with either a bankrupt tenant or an oversized tenant. Sometimes you'll see things called that has a Burlington in it. Burlington used to take 70,000 square feet. Their new size is 40,000 square feet. So you don't want to buy something that's got an oversized tenant where you're going to have to figure out, okay, if they downsize, what am I going to do with the other 40,000 square feet? And then if you go to a secondary market, I don't want to be buying the third best center in a secondary market because your tenants are going to leave to go to another center if space opens up. And I think the value of the underlying real estate and making sure it's just great quality, great location, lighted intersection, I think that probably speaks to me more than what you're going in cap raters or the yield is, because you can't replace the underlying real estate. And if it's great real estate, you're going to go up in value.
No, that's interesting. Yeah, I mean, I'd like to get better at being able to be okay with a lower cap rate deal in a really good market, knowing that rent growth is going to be higher. Sometimes we overlook those deals because we can't get to our return metrics day one. But are we really doing a good job of forecasting how well great real estate goes up in value due to rent increases?
And that's kind of why we took a shot at that Houston deal that we closed on, because that grocer, it's great real estate off the highway, and that grocer did phenomenal. And they're only paying $6.50 a foot in rent. And market based upon their sales should be a lot higher. And we could forecast, hey, we have the right to retrade their rent in 3 years, and value of this center should be this. And here's your 2 vacancies, and here's where people are coming in for renewals. So yeah, it wasn't a high cap rate going in, but I think having the right partners and knowing the value of that real estate and the tenancy is kind of what made that attractive for us to do.
Well, good. Let's get Jackson in. So Jackson, I don't know how much your strategy differs from Andy. Is there what is it that you find yourself gravitating towards when you're looking for deals? What are the main things that you think draw you to making offers on a particular deal?
I think I'm a little bit different than Andy in the fact that I'm a little bit more analytical. So when I see a property, one, we got to check off the demographics, like Andy was saying, and the market. So, where are you in that market? Are you in a main MSA? Are you in a secondary market of that MSA? Are you located on the A street, the prime retail corridor? Are you on that kind of B street, as I like to call it, where you're still getting good traffic, but you may have lower rents because of it, or seeing some tenants relocate. But I'm just hyper analytical. I can't break up a deal like Andy can in 30 seconds and say, hey, this can work. I'm like, we need to underwrite this now. Let's see if it works. It's a good cap rate they're, listing it at. And it is good real estate in the end. But yeah, tenant lineup. And I think mostly about tenant lineup for me is matching up with the demographics. Like if you have a Ross in a super high average household income market, it's probably not serving the best use there, right? And so their sales may not be the best and they may choose to leave. So I think it's matching up to your tenant lineup with your surrounding demographic, the ones that are going to serve that center the most, and making sure you're comfortable with who's in the center. Or maybe that's, another value add play where you can bring in some vacant spaces, bring in some tenants to those that will match up with that demographic. So I try to look at things at a high level, but I usually end up just going into the weeds right at the start.
Like it.
Yeah, I would say we're kind of a combination of both. I mean, I know you underwrite deals very fast, like Andy, kind of quick and dirty, quick, high level. And then if it works in, I would call it stressed, quick and dirty environment, right? Then we know there's room for upside and kind of like digging in.
Yeah.
So I would say, yeah, you've got to have some efficiency in how you're analyzing them so you don't get caught up, right? Like we looked at 30 deals at least over the past week. If we got into them and spent 4 hours on an Argus model and multiple hour phone calls with the broker asking questions, you'd be really discouraged really fast because you'd find out that you wasted a lot of time because you're not buying the majority of these assets, right? So I think you got to do a hybrid of both. You got to learn how to do a quick and dirty in the beginning. But I think it's insanely valuable to be able to detail out as much as you can. The more accurate
we showed that last week on the podcast where we went through some deals and there were some that we didn't like, right? In 5 minutes, we knew we didn't like them and we went on to the next. We saw some that we liked and then we dug in a little deeper and made offers on those. So, we've talked about that on the podcast before.
Yeah, I think some of the initial underwriting is perfect, is the enemy of good sometimes. And then definitely towards the end, you want that model as close to perfect as possible. But the reality is the day after closing, it's probably a little different. Everything is always a little different. I know we're underwriting deals now that are 100% occupied and we're building in like 4% vacancy and there's all of these renewal assumptions in Argus, right? Like what's the probability the shop space tenant is going to renew? If they don't hit this, if they do hit this, and it's hitting a probability of both of them, it's hitting a combination of both of them based on the probability of that renewal. So it's not the most accurate. It's kind of like a blend of all of your probabilities, if you will.
Mm-hmm. Another question I have for Jackson, because you are kind of a lot of investor relations, and you're even connecting with a lot of new investors that sign up. You're cold calling new investors. What do you think is the main drivers for them? What gets them interested and excited? I'm sure with all these phone calls, you may have some deal points that don't seem to resonate, and then you have some deal points that seem to over and over resonate. What do you find is important to new investors that haven't really invested a ton with us?
I think it's mostly understanding what they want, right? So like if I cold call investors, it's kind of a 50-50 mix. You'll get a lot where it's, hey, I want quick in and out development deals. I want to be in and out in 12, 24 months. Or the guys that just like cash flow. So if you're looking at a cash flow deal, I think the points that resonate most with them will be the cash on cash return and seeing that growth. If we can say, hey, we're going to come in and we're only getting a 10% day one, but we're going to have, this tenant's going to have an option that goes up 10% on their rent. And we got 3 vacancies we think we can lease up. And now you're looking at a 14% by the end. That usually resonates with them with a lot because they're just seeing their distributions go higher and higher and getting more of their return on their investment faster. And then I think it's just the deals that we can find, like Houston, for example, where there's different value added other than just raising rents. There's out parcels we can sell off. There's kind of, quick and easy ways to do a return of capital to the investor. I would say those two are basically the best deal points I at least get the best feedback from. So other than that, it's really just getting them familiar with the real estate. Houston was a great one. Our St. Louis deal was another good one because it's just places people know and can understand a lot easier than, some of these secondary, tertiary market deals.
Good feedback.
I always wonder, Jackson, when you call these investors and you're pitching a 20% plus IRR, what would keep them from investing? Do they think they can get a better return on their money somewhere else, or they just don't know real estate, they don't know us? What would keep them from investing with us?
Yeah, I think it's one, they may not be comfortable with us. They just don't know us yet. They haven't invested yet. But I think more so it's getting them familiar with the deal. And, the return is the return. I've spoken with a lot of guys that love the return. But then they ask, what happens if it doesn't work out? And so a lot of what I've done too on these calls is just kind of played with our model live and then saying, hey, if XYZ doesn't happen, give them kind of a worst case scenario, if you will, or on a development deal, for example, if we're projecting 24 months, just showing them what the return would be if it does go longer, and does go to 30 or 36. I think that helps them realize the risk of their, time value of money in that case, and really see, okay, well, if we sell this, call it a Starbucks development in 18 months, I get a 25 IRR, but if we sell it in 24, I still get an 18. Okay, now I feel more comfortable with the deal. So I think it's just really getting out in front with the risks first, and then obviously the returns as well of the deal. But yeah, I think risks are what get people the most comfortable with us in the end.
Yeah, I mean, I think, yeah, you're kind of the first line of defense, right? Like we have so many, not so many, a decent amount of new leads coming in every single day, and you're tasked with getting them on the phone and saying, hey, my name's Jackson. Saw you signed up on one of our, requests for information, whatever it is. So yeah, I'm sure those are very interesting phone calls. I see your notes from you hitting the phones. It's a lot, man. And then, Andy, I think is generally talking to a lot of people once they're getting closer. Maybe I think Andy is, he's doing some investment videos on the past couple of acquisitions. I think that, generally people want to call the person that they feel like is the most familiar with the deal. So when you're doing the video walkthrough explaining the financial plan, I mean, you're getting a lot of phone calls. Yeah.
Just having that kind of transparency, I think, makes people feel more comfortable with us as a sponsor. I think as we exit deals this year and build that track record of exited deals with IRRs attached to them, and they can just see, hey, we don't hit a home run every time, but we haven't had an IRR less than X, and we've hit several IRRs north of 25, 30. I think that'll start to get people comfortable. Hey, my odds are good that I'm gonna make a good return on these deals.
Yeah, we've bought a lot of deals. We just haven't sold
A lot, yeah. Well, guys, I really appreciate you coming on today. Definitely wanted the audience to hear from you guys as we build out our Fort Worth and Dallas offices. Anything else, guys, today?
I don't think so. You guys got anything else?
Don't say yes all at once.
I guess not, but we got deals coming, so be ready and stay tuned. Next couple weeks, we may be launching our next one.
Yeah, seriously, we're working on the pitch deck for the next one. We've got several counter offers in. I know after this, we're probably going to grab lunch and review some more counter offers. So, yeah, if you've got money to place, I know we're looking at trying to gain as much depreciation as we can in 2024. We discussed last week, if you get a deal and contract today, the probability of you closing before the end of the year is still very high, right? But a 60-day deal timeline from today, which is hard to meet in this environment, is November 17th, November 19th, right? You've got a month to spare. And some of these PSAs take a month to work out. Sometimes you get delayed because of a phase one or a property condition report or whatever it is. So,
and Christmas and the holiday season, it cuts out at least a week or two of December.
Yeah. So just final motivation. If you're looking at deals, if you're wanting depreciation, I just think of the people saying, oh yeah, I bought a truck at the end of the year and just like, I want to hit people.
Last comment I'll make is if you are thinking about investing before the end of the year, get that depreciation, get some money earning interest, hit us up. Let us know, because we're trying to make decisions on how many of these deals we take under contract. And the more knowledge and foresight we have on investors that are wanting to get invested into deals, that'll give us the confidence to know which deals and which size of deals to go after to make them available for everybody. All right, guys.
Absolutely. Okay. Well, we will catch you next week on how to invest in commercial real estate.
Thanks.